Good day, everybody. Thank you for the privilege of joining this session to talk about a very important question. How do we get some good measurements for carbon emissions and the remediation of carbon? Accounting is all. I have an accounting background. Accounting is all about measurement, and so what I'm going to talk about is bringing the ideas of how we do accounting to the accounting for carbon. What you'll see, I'll explain, is that we'll have a balance sheet, we'll have an income statement, similar to financial accounting, but of course dealing with not with dollars, but with units of equivalent units of CO2 emissions. So it's an application of just financial accounting to this very important topic about accounting for carbon emissions, which this conference has emphasized is a very important issue in front of us. So if we think about our financial accounting system, we have a balance sheet. And the balance sheet has assets. And these assets are those which investments which project future benefits. And so when we come to our carbon balance sheet, it will be a balance sheet which assets which project future benefits. The balance sheet also has, in financial accounting, the liabilities that net out against these assets, which are obligations to satisfy certain commitments in the future. And we'll also have liabilities, which will be a firm or an entity's obligation to deal with carbon emissions in the future. The difference between assets and liabilities, of course, are in financial accounting, are shareholders' equity. And that represents the interest of a particular investor in those assets and liabilities. So the carbon balance sheet here is going to have the same form, with assets, with liabilities, and with a net to an equity number, which is the interest of a particular interest in the assets and the liabilities. Supplementing that will be an income statement. And as in financial accounting, we have an income statement, which is the net benefit to the shareholders on the bottom line from a period's endeavour. That's revenues, benefits, minus expenses to give that net benefit. We're going to have also a income statement. However, the income statement, of course, again, is going to be in equivalent units of CO2 emissions, where the benefits are the benefits that a firm or an entity provides in terms of reducing carbon. And the expenses are going to be their generation of carbon, with the net number being their net generation of carbon or the net reduction in carbon. As with shareholders, as with financial accounting, that income statement is going to be closed to the balance sheet. So there's going to be a reconciliation between the income statement and the balance sheet. And that net benefit that a firm generates with carbon, more likely, of course, a net deficit, will be represented by assets and liabilities in the balance sheet. So that's just our financial accounting system laid into this situation, but with a similar sort of thinking. Now let's think about how carbon's accounted for at the present. Well, there's no balance sheet. There's no statement of a firm's net position in carbon at the moment. That's going to be remedied by this carbon accounting. There is an income statement. That income statement, using GHG protocols, indicates the flows in a period of firm's carbon. Usually broken up into Scope 1 emissions, which are the emissions for which a firm is responsible. Scope 2 emissions from carbon acquired from the upstream, and Scope 3 emissions for carbon generated from the downstream from the distribution of the firm's product. But there is just a net number. There's just a carbon generated this period. It's a number which has been challenged very often without not having good discipline. The accounting for carbon brings that discipline, as we'll see. And of course, without a balance sheet, there's no reconciliation of the net carbon generated in a period to the balance sheet. So that's the broad outline. To give you some idea, because we probably won't have time to go into it completely, that the assets are, hey, what the firm is doing to remediate carbon in the future. What's it doing this period in terms of capturing and sequencing carbon? That is an asset. What's it doing in the future in terms of having in-house remediation, out-of-house remediation, or avoiding carbon, simply, for example, by preserving a forest rather than logging it? These are assets will go on the balance sheet, and on the liability side will be its obligation to actually meet these promised assets in the future and any other liability generated by the firm. But the big difference is the definition of the shareholder's equity. In financial accounting, that is the interest of a particular type of investors, the shareholders of the owners in the firm. So what is it here? Well, the shareholder's equity here is you. It's you and me, who are the ones who have, or society in general, who have the interest in carbon reduction and carbon remission. And we want to monitor entities in our interest in doing that. Those specific constituents could be regulatory bodies who are regulating carbon, taxing authorities who are taxing carbon, litigation, people in litigation, climate activists, a whole host of them. But generally, it's just us. It's a reporting to society about how this firm, or actually it may be a non-profit, it may be the government, it may be the Defence Department, to the extent to which they are acting in our interest and what they're contributing net to the problem. So that's you can see the accounting now is really a responsibility accounting, reporting to us about what you're doing, what you're doing presently, and the projection into the future through assets net of liabilities of what you're putting in place to reduce carbon in the future. There are other accounting for carbon systems out there. Romana and Bob Kaplan at Harvard have their e-liability accounting. I think this has been reported on in a previous CARE conference. It's embellished by Stefan Reichelstein, which was reported, I think, at the last CARE conference. And that is a product cost in carbon. It keeps track of the carbon in particular products, from cradle to gate, as they say. So when you buy a car from GM or BMW, you get a report of how much CO2 emissions have been, how much net emissions in CO2 have been generated throughout the whole supply chain. And you can make a decision as to whether you want to buy that car or you want to look at a car with a lower embedded emissions. That's a managerial accounting system. It's a cost accounting system. A costing for carbon in cost of goods sold would be the financial accounting equivalent. My accounting differs in the sense that it's an entity accounting. It's accounting for the entity, about how an entity, the extent to which it's working and being responsible for satisfying us, who are the constituents. For we young people have to have a future. They're very concerned about it. And the projection of what that might look from a particular firm is going to be very important. And that's where an asset, a balance sheet with assets and liabilities which project into the future is a very important feature of this accounting system. So let me think about they are just some of the features. I'm not going to get into the weeds. You'll have to look at the paper. It's up on SSRN, Social Sciences Research Network, to get the full details and to follow in. It's very detailed. It takes you through the journal entries, the transactions, and how they end up in the system. What I want to emphasize here more is what the system involves. First of all, it's a stocks and flows accounting, as I've just said. It's not just the amount of periodic carbon, but it actually reports not only your periodic carbon, but your net accumulation over a period of time and your carbon position. That we call stocks accounting rather than flows accounting in a balance sheet. And so that stakeholders' equity, our equity, in a sense, in the firm, is updated, and so we get a periodic indication of where the firm is now in terms of doing this. From the firm's point of view, of course, it's a liability, as it were, to the or their benefit to the stakeholders in their operations to actually deal with CO2 emissions. The units are in CO2 or equivalents from methane and so on and so forth. So we get this aggregation over time. Yes, the annual periodic emissions are aggregated. And if in fact it gets worse, the stakeholders' equity gets more and more negative. If in fact there's a reduction here, the progress over time, we see the stakeholders' equity becoming more and more positive. And so we have the as in financial accounting, we have just not the flows reported, but the stocks. Where are we now? As in financial accounting, it aggregates like amounts into subtotals to give summary numbers, which are easier to appreciate and to analyze. I've been told that at least at one time, under regulations and discussions about carbon, there are 1,144 different metrics that are used. Here we try to reduce that into summary numbers in categories. What is your potential carbon reduction from in-house remediation, from sequestration, from buying that land and restoring rainforests in the Amazon? So that aggregation takes place to give some summary measures which you can lash on, and I think cuts through a lot of the loose accounting that we see on this issue. As I said, it's a responsibility accounting. It's an accounting that is for the entity. That here's what this entity is doing for us or not doing for us, who are the stakeholders to whom the accounting is reporting. And thus, particularly with a balance sheet which tracks over time, it disciplines the entity, the firms. So, for example, if there are promises of net zero by 2050, over time, the accounting tracks the progress towards net zero in 2050. Knowing that you're going to have that accounting, that brings discipline to all these promises, which sometimes are seen as loose promises, undisciplined promises, to make unbiased promises, because you know that the entity knows it's going to be checked up later through the accounting in the future. So are they meeting milestones? Well, we'll see as, in fact, this accounting rolls out in the future. And of course, so therefore, it's helpful, I think, in terms of cutting through the babble in this area, the greenwashing, bringing a real discipline to the issue. It's a double entry system. And so those of you accountants understand how wonderful this double entry system. This double entry system, which worked very well for the Venetians for 500 years, that works very well for financial accounting in terms of properties, also can be applied to the accounting for carbon. It not just a double entry just doesn't give checks, but it gives information where stocks and flows have to be reconciled, and you can't go out of those bounds of double entry. As I suggested, it's very useful for thinking about the future for planning. So we typically call that pro forma accounting. The accounting for the future. So planning, laying out estimated future balance sheets and income statements can be laid out in terms of what matters. And that is planning, and of course it's also control, so that once that a firm gets to that point in time, that milestone, whatever it is, it's evaluated on whether it's meeting that milestone. So the pro forma statements, complemented with the actual realized accounting, is a control mechanism. It lends itself to consolidation. The accounting deals simply with scope 1, although scope 2 can be added for informational purposes. Scope 1 is simply the carbon that is being generated by the entity itself, for what it's responsible. As such, it can be consolidated. So if you want carbon emitted by the automobile industry, you can just do consolidation accounting with no double counting. If you use scope 2 or scope 3 accounting, of course, you'd have double counting. As I said, scope 2 can be accommodated. Scope 3, no, simply because, as everyone claims, scope 3, estimating how much a customer, a buyer of a car is going to generate in terms of emissions in the future, is considered almost an impossible task. So consolidation. So we can get a figure of how much the chemical industry in a particular country is generating, how much we can do it by government department, how much the government's emitting carbon or remediating carbon. We can do that on a net base. Further, in the parallel of financial statement analysis, financial statements, we can do financial statement analysis where we compare line items one to another. We do this in pro forma, and we can do this in actual. That's very important because when doing the accounting in the same form as financial accounting, there can be a comparison. So you might be investing in corporations for retirement, and you want wealth from retirement. You want them to do well. Actually, you want to be able to live in retirement and not have carbon wipe you out. So you want to make a trade-off. You probably don't want absolutes of no carbon, but you want a relative assessment. Yes, here's a firm that actually is going to give me wealth in retirement, but actually is low carbon. That one I'm going to prefer to one that generates wealth for retirement, but generates more carbon. So we produce this comparative analysis. I think that's quite helpful. Being the accounting being in the same form as the financial accounting statements. Of course, in accounting, we've got to develop accounting principles, and the paper lays out those accounting principles. First, we've got to the realization principles in place. The flow statement only reports realized carbon and realized carbon reduction, not estimates of the future. The realization is very important. How much are you doing for me this year? Okay, in actual, realize a net carbon reduction or a generation. And secondly, it's governed by the reliability principle that what we have in here has to be reliably measured. This is possibly, this of course is in financial accounting. We don't book a liability if the probability is remote. And so this applies here. Now, measurement in this area is very difficult. And it may be, as you read through the paper, you'll see, well, that's going to be hard to measure. If so, and not reliable, it cannot go in. So the way to think about this this accounting is, here's an ideal system if in fact we can get the measurements. If we can't get the measurement, we don't want to build in fluffy numbers, and that reduces then the comprehensive accounting and the informativeness that the comprehensive accounting gives us. Another way of saying is, here's a point of departure to think about how I would do the accounting if I got the measurements. And if I can't get the measurements, we have the standard default. If you can't do the accounting quantitatively, then you have disclosure. And on that point, just note that most of the regulations having to do with carbon are disclosure regulations, from the European Corporate Reporting Sustainability protocols, from the European standards, from the ISSB standards. They're disclosure standards. They tend to be more qualitative. In accounting, we say, hey, you only have disclosure if you can't do it quantitatively. So here's a point of departure. If you can do it quantitatively through an accounting, you don't need the disclosure. But if you can't, then you have to have the disclosure. And so it draws a line between accounting, formal accounting, getting measurement with the rubber hitting the road, versus disclosure. So there are other accounting principles you'll find in the paper in terms of recognition, what's to be recognized, what's not to be recognized, and of course, measurement. So that's an outline of the system. I hope you get a sense of it. The devil's in the details. If you get into the paper and read it, I'd like you, if you will, to email me and say, hey, Penman, what about this situation? Can it deal with this situation? In the paper, there's a number of situations firms are in, and how it would be accounted for. A long list, actually. But I'm concerned about, is there a situation in which we're interested that your accounting does not cover? Please email me and let me know, okay? And so I thank you very much for your attention.